So, good morning, and I'd like to welcome you to Colley Bristow. We are a central London law firm, and we have a particular interest in financial services, both contentious and non-contentious. My name is Robin Henry. I'm a partner in our banking and finance disputes team. And I have here with me our colleagues, Nigel Brahams, who's a partner in our financial services department, Simon De Broys, who is a senior associate in our banking and financial disputes team, and Janine Alexander, who is a partner also in our banking and financial disputes team. So first of all, we're going to have Nigel Brahams, who will be discussing the impact of the pandemic on the SMCR regime, followed by Simon, who will be discussing the latest guidance to lenders from the Prudential Regulation Authority on initial and further payment deferrals. And finally, we will be having Janine Alexander, who will be providing an update on LIBOR transition and recent activity relating to that. You can submit questions if you would like via the Q&A function on your screens, and we will put them to the panelists at the end of the webinar. And just a reminder that slides and a recording of the webinar will be sent as a follow-up. So with that, I would like to hand over first to Nigel.
Okay, good morning. Thank you, Robin. Good morning, everybody. So I'm going to be sharing my screen, and I've got some slides on the senior managers regime and COVID-19. So hopefully I can do this successfully. And hopefully everybody can see my slides. So, I'm assuming, well, I'm not going to assume that everybody knows all about the senior managers regime. So I'm going to have a quick recap on that, and then I'll explain how the FCA and PRA have flexed somewhat during the COVID-19 crisis. So just a quick recap. The senior managers regime is actually a mixture of several different regimes. It tends to be known as the senior managers regime, or SMCR, but actually stands for the senior managers and certification regime. And this approved the FCA's old approved persons regime in several stages. So firstly, from March 2016 for dual regulated PRA and FCA regulated firms. That meant largely large banks, deposit taking institutions, etc. Then in December 2018 for dual regulated insurers, so large insurance firms. And then probably most significantly, and certainly in terms of the number of firms affected, from December 2019 for solo FCA regulated firms. And one of the ways you can see this in action is if you are like me and you happen to check in on the FCA register from time to time, particularly if you've got somebody on the other side of a transaction you want to look up, you find that the trail for most of them stops in December 2019. They're no longer an approved person. And my first reaction was, oh God, this person's no longer an approved person. There must be something wrong with them. And then you realize, of course, that unless you're a senior manager, which is a very small number of people, the FCA is no longer directly interested in registering you. So I'm going to talk about each part of the regime quickly, but this splits in three parts: the senior managers regime, the certification regime, and the conduct rules. And a nice little pyramid here, which just gives you an idea. If you think about at the top of the pyramid, you've got a very small number of senior managers. So it could be an institution where there are 2,000 people, you might have 10, 15 senior managers. Below them, you've got certified employees, and I'll talk more about them. And under that, you've got employees who are just subject to the conduct rules. And then below them, at the very bottom of the pyramid, you've got people who are completely excluded from the regime. And I'll talk about each of those in turn. I may flip back up to this pyramid in a moment. So at the top of the senior managers regime, and this is important for COVID purposes, you've got the senior managers. And these are split into several senior management functions, or SMFs. And there's a whole range of those. For example, the CEO, head of compliance, money laundering reporting officer. You've got branch heads for foreign banks, and there's actually, I think, about 29 different senior manager functions, but not every firm has to have every function. But every senior manager does need to have what's called a statement of responsibilities, and this is a quite detailed statement in a prescribed form the FCA requires, which is submitted to the FCA and PRA, listing exactly what that person does and what they're responsible for. And the idea of the senior managers regime is there should be no gaps in management. So if something goes wrong within a firm, there is always a senior manager at whom responsibility can be pointed at. So the FCA handbook and PRA handbook give much more detailed information on this. Now, when this was introduced to the solo regulated firms, the FCA appreciated some of these firms were much, much smaller and didn't have capacity for vast numbers of senior managers, and it's been applied differently for them. So below the senior managers regime, we've got something called a certification regime. And this applies to a much wider population of employees who previously would have been approved persons. So these are typically people sitting under the senior managers. And it applies to people who have what's known as a significant harm function. And this doesn't mean that these people cause significant harm. What it means is that if they were to do their job incorrectly, they could cause significant harm, not only to the institution they work for, but also for the market generally. So quite typically, these could be very senior risk people, albeit people who are not senior managers themselves. It could be senior traders within banks. It could be a senior investment manager within an investment management firm, or within smaller firms, it could mean a senior IFA. Really, somebody who has an important influence function. Now, these people are not approved by the FCA any longer. They're no longer approved persons. They are approved by their institutions, and they're approved on an annual basis. Then below that, we've got the conduct rules. So conduct rules apply to everybody, and actually there's an extra set of conduct rules which apply just to senior managers and around their responsibilities in management and control. But the basic conduct rules set a minimum standard of individual responsibility and behaviour. So they apply to pretty much everybody within the firm. And if you go back up to my pyramid here, these are the people here. So the certified employees are here, and the senior managers are just up at the top. And the only people who are excluded from the senior managers regime are typically people who don't do any form of financial services work at all. So this would be the cleaners, reception staff, catering staff, possibly some very junior admin staff, but really anybody above that, anybody who has any influence in terms of or can affect how a firm is run, is subject to the conduct rules. The conduct rules are not overly onerous. I mean, they would include things you expect around sort of acting with propriety, honesty, etc. So, and just within solo FCA regulated firms, there are 3 different tiers. So at the top end, and unfortunately at the bottom of my slide, the enhanced tier, these are large firms which are solo regulated. So the only firms which are dual regulated are banks, effectively deposit takers, who are regulated by the PRA under the auspices of the Bank of England. But other firms, you can have quite big investment banks, as long as they're not taking deposits, who will still be an enhanced solo firm. And those firms are often as big as the banks, and so they are subject to quite a sophisticated regime, very similar to that for the banks. Then above that, you've got the core firms. They have what we know as baseline requirements. They don't have to have as many senior managers. And then really at the top of my slide, but at the bottom of the tier, you've got limited scope firms. These are small firms, so it could be like a small IFA, a boutique, corporate finance boutique with a small number of people. These are firms which don't need to actually have very many senior managers at all. Typically, these are firms who don't handle large amounts of money. And they only need a very small number of senior managers, typically a compliance officer and somebody called a limited scope function, SMF29, which is the person who's managing that limited scope firm. So what about COVID? How's that affected things? Well, the FCA and PRA, who are jointly responsible for supervising senior managers, produced a joint statement on the 3rd of April. Obviously, this was a time when the current crisis was at its very worst. Things have abated somewhat since then. Both regulators stated they recognised that there were challenges for regulated firms, both in terms of they may have furloughed key staff, they may have even furloughed senior managers, and there's certainly lots of issues dealing with remote working, particularly in large banks. In fact, one of these interesting things I heard recently was that certain employees within large banks and the trading floors have had to be in the office under socially distanced rules, to do with the speed of trading, because of when you have algorithmic trading. If you're at home, you can't trade quite. You're a few hundredths of a second behind where you would be if you had all the technology in your office. But those people apart, the majority of people in financial services are probably working remotely now. And that creates challenges in terms of keeping tabs on what people are up to. And the other issue you've got is if you've got a senior manager who's been ill, maybe with COVID-19, what do you do? So the FCA and PRA put in place some temporary arrangements to cover absences of senior managers. One of the things they have said is that there doesn't need to be any one single senior manager who's responsible for the response to COVID. That's probably quite sensible. If that senior manager was to go off sick with coronavirus, then there would be nobody. So effectively, it's a kind of team effort amongst the senior managers who are already there. The FCA's approach is that they want the senior manager, they want any substitute senior manager ideally to be drawn from the ranks of existing senior managers. So somebody who is themselves used to complying with the regime. So an example might be where you have a head of risk and a head of compliance. And if that head of compliance reported into the head of risk, the head of and then went off sick, the head of compliance would take over both roles on a temporary basis. Of course, with the large banks, they're probably unlikely to have furloughed their head of compliance, their head of risk. These people are obviously too critical to the continuance of their businesses to be furloughed. But in a small firm where you only got 5 employees, one of whom is the compliance officer, one of whom is the limited scope senior manager, and you've lost half your income, you may well want to put somebody on furlough, take advantage of some of the business interruption loans, take advantage of the government's furlough scheme. And in this case, the FCA does appreciate you're going to have to be a bit more, there's going to have to be a bit more sort of fluidity amongst that. So if a senior manager is absent, what do you do? So you need to update your statement of responsibilities, and you need to update what's known as your management responsibilities map. Now, in very large firms, the management responsibilities map, literally I've seen ones which have run to 70 pages. They are vast, very, very complicated structure charts indicating who's responsible for which aspect of running that bank and who reports into them. And it's a massive network. There's no prescribed form for management responsibilities maps. And so for a much smaller firm, it could be very simple. It could just be a simple flow chart or Venn diagram. And you are required to update that so you know where the responsibilities lie. And this is really, so if an issue was to happen within your institution, you would be able to point to the person who is responsible for that issue. Obviously, in a very small firm, it's not particularly difficult to do that. In a large firm, it's much more complex. The FCA doesn't require that you resubmit statements of responsibilities and maps. They just want to know that you've got an internal record so that if something does blow up, they would know what to ask for and where to look, and that you would be able to prove to them that you had kept in touch and you'd kept up to date and you'd updated your map. What is the status of a furloughed senior manager? Well, that person is effectively dormant. They're not in their role. They're not responsible for their role whilst they're on furlough. However, they do remain approved by the FCA. And the good news for them is they don't need to be reapproved when the furlough scheme comes to an end, and hopefully they're reappointed to their job. The regulated firm remains responsible for ensuring that any senior manager, and that includes a temporary senior manager, is a fit and proper person. However, the FCA have given some sort concessions in terms of not needing to file certain forms for temporary or long-term leave. So there are certain senior managers who are required to be in situ at all times, even during the current crisis, and possibly even more so during the current crisis. So I would, in terms of dual regulated firms, that's the big firms who are regulated by both PRA and FCA, you always have to have a CEO, and you always have to have a CFO, because these people are so critical to the functioning of the firm. Similarly, the UK branches of overseas banks must always have a head of branch. There has to be somebody who the regulator can point at, and if that person is off sick because they've got coronavirus, then there needs to be somebody appointed in their place. Just slightly down a notch from there, the FCA and PRA have indicated that they only expect firms to furlough their compliance officers, money laundering reporting officers, as a very last resort. And in the case of a limited scope firm, that the limited scope SMF function, the person who actually runs that limited scope firm, these are very much last resort things. You cannot not have a compliance officer. There has to be somebody who the PRA, FCA can talk to. So how are the concessions done? There's a process which the FCA created. They issued a missive on this in May called modification by consent. And this is really available to solo firms. And this is because the FCA recognise that it's much harder for solo firms than for dual regulated firms, generally because they're smaller. They've also relaxed what's known as the 12-week rule. The 12-week rule is a rule which allows a senior manager function to be in place for up to 12 weeks in any 12-month period without having to be registered with the FCA. And so they said this, with modification, with consent, this can be expanded to up to 36 weeks. And this modification by consent isn't just for the 12-week rule, it can be for all sorts of short-term arrangements that a firm needs to make. So, in conclusion, I think the FCA and PRA do recognise that working remotely, I have a nice picture of an empty office there, it does create issues. And you can't, and particularly I'm thinking in terms of institutions where there's an active trading function. If you think of some of the trading scandals that have happened over the years, and it's often been said that you can tell quite a lot about traders by their behaviour in an office, and managers would be watching to look for sort of extreme or unusual behaviours amongst a trader. Somebody's gone way beyond their limits, who's got themselves into a mess, is likely to be looking very, very stressed. It's very, very much harder to see that when you are working remotely, when you can't see each other. I think the FCA and PRA have displayed a degree of flexibility here. I think also they recognise the importance of the regime, because it's effectively an absolute stress testing of the regime going on at the moment. And so it'll be interesting to see whether anything comes out of it, whether we see any prosecutions or issues around senior management functions. So anyway, that's pretty much all I'd like to say on this topic for now. And I'm now going to return you to Robin and to the next set of slides.
Thanks very much, Nigel. I have received one question, but we'll deal with that, if I may, at the end of all the sessions. And I'd now like to hand over to Simon.
Thank you, Robin. Thanks very much, and thank you, Nigel, for your talk. So today I'm going to talk about the guidance from the Prudential Regulatory Authority during the COVID crisis, and how that's evolved over the course of the crisis. So just jumping straight in, as the scale of the pandemic became aware, that the Prudential Regulatory Authority was fairly quick off the mark to get guidance out on how it expects its members to respond in the face of the pandemic. And there's been a range of updates and guidance notes, and in particular 2 Dear CEO letters have been published, which, considering we're only halfway through the year, that's relatively rare, but as you'd expect in sort of these unprecedented times, it's been necessary to do that. The guidance has evolved over the course of the crisis as the sort of scale has become more apparent. But its main objectives have been fairly constant and have remained unchanged, which is to keep the credit markets open, and in order to do that, make allowances for borrowers who have been directly affected by the pandemic. I think at no point has it suggested that lenders should show leniency where there is a real credit risk unrelated to the pandemic, but where borrowers are directly affected by the pandemic, the PRA has been very clear that it expects a different approach to be taken. So moving on to the first Dear CEO letter, this was published by Sam Woods, the CEO of the PRA, on the 26th of March, quite soon after lockdown, so quite early on in the crisis, or at least early on in the UK's response to the crisis. And it is based on, I think, an early assumption that disruption to the markets would be relatively temporary and that activity would bounce back sharply. I'm not sure if that optimism is still shared. I think there has been a bounce. Quite how far we've bounced back, I don't think that's clear yet, but certainly no one's expecting a very quick recovery. But anyway, notwithstanding that relatively early optimism, the PRA was very quick to focus on one element of the regulations in particular, and that's the International Financial Reporting Standard, RS 9, and the implications that can have on a lender's capacity to provide credit in the market. So IFRS 9 came about in part in response to the 2008 financial crisis. It was being developed prior to that crisis, but was certainly shaped by some of the issues that arose during and after the crisis within banks. And it requires lenders to take a forward-looking approach to assessing what their expected credit losses will be, or ECLs. And so very much aiming to get lenders to think about what's coming up in the future in the next quarter, rather than assessing where they are at that day. Now, the importance of this is that the ECL levels will then dictate what capital requirements lenders have, how much provision they have to make for bad loans under the EU's capital requirement regulation. So they're all intrinsically linked, and so it's extremely important that I think the PRA certainly noted early on in the crisis it was extremely important that borrowers shouldn't be marked as in default too early on, because in doing so, the banks would leave themselves very little wriggle room to manage their capital requirements. If numbers of defaults increased massively, that would in turn require them to adjust their expected credit losses, and in turn then their capital requirements would go up, and effectively the credit markets could be shut down very quickly, which is something that the PRA wanted to avoid at all costs. Otherwise it would simply be undoing all the work that the UK government is doing by pumping liquidity into the market. So with that in mind, in its first letter, the PRA urged firms not to overstate ECLs in what it said, in the absence of reasonable and supportable forward-looking information. So effectively, if you need to assess whether your borrowers are in fact suffering a bad credit, or their business is going under, or whether it's just a direct effect of the pandemic and all the associated issues that come with that. So they were clear that lenders needed to really take this into account. It was also the PRA was also very clear that they wanted lenders not to treat payment holidays as a default, and that where the pandemic was a direct factor, potential defaults, as it termed them, should be treated differently, and certainly payment holidays should not be considered to be a default. And this ties in with the FCA's guidance at the time in relation to retail lenders, which was that the 3-month payment holiday should be permitted where the pandemic was a factor. And finally, the PRA also advised lenders to waive covenant breaches, again in circumstances where the pandemic was a direct factor, and that these waivers should be without charges or additional restrictions or requirements. So the PRA then issued, in relation at least to lenders, further guidance towards the end of May, which coincided with with the end of the first period of payment deferrals, which were initially granted for 3 months. And again, the PRA was keen to sort of avoid a cliff edge where at the end of payment deferrals and holidays, lenders would then simply issue defaults to borrowers because the position hadn't changed and they may still be unable to pay. So again, the PRA urged lenders to really think carefully and assess each of their loans and whether any payment defaults that were actually caused by the pandemic, and if so, they should be treated accordingly, rather than simply issuing defaults at the end of payment holidays. Again, just to avoid the cliff edge, huge numbers of defaults would in turn mean the capital requirements would go up and the credit markets would begin to tighten again, which is something we wanted to avoid. So this was followed up on the 4th of June with its second Dear CEO letter. And this dovetailed with the FCA's guidance that extensions to payment deferrals and holidays should be granted to retail borrowers. And again, the message from the PRA was consistent, not automatically treating loans as being default where extensions were granted. These exceptional extensions in the face of the pandemic, which should not be treated as defaults, thereby they would not be impacting on ECLs, and that they should assess each of their borrowers on a sort of a borrower-specific information. Again, the general theme running through all of this is that if your borrower, whether it's retail or a business, is being directly affected by the pandemic, they should be treated differently. There should be exceptions made, where ordinarily there wouldn't be a requirement to do so. And again, this is all aimed at keeping expected credit losses low, which means that capital requirements will not be greatly increased. Also in June, the EU issued their credit requirement regulations quick fix package, which came off the back of an agreement by the Basel Committee in April 2020. This brought in a sort of very rapidly brought in a whole raft of amendments to the regulation, and an acceleration of some of the new provisions which are coming through on the Capital Requirements Regulation 2. The purpose of this was severalfold, but in summary, it relaxes the requirements of credit capital requirements for lenders, and it aims to keep the markets liquid. This regulation obviously still applies to the UK until the end of transition, but it builds very much the same theme of what the PRA was trying to encourage prior to this. But now there is the underlying regulation also makes adjustments to the calculations of what capital requirements need to be put aside. So there's now sort of the primary legislation to assist the guidance from what the PRA has been trying to achieve. Again, it's relatively early. This only came out sort of 2 or 3 weeks ago. So too early to exactly see how this is impacting the markets. But certainly, all regulators are working towards the same theme, which is to not to clog up the credit markets. So how are the banks, just to finish, how are the banks responding to the guidance? I will just move on to a chart that was published in the FT recently. You can see here the light blue bars are the credit provisions made in the first quarter of 2019 as a percentage of the loan book, and then the dark blue bars are this year's first quarter. And you can see that the banks are very much keeping their own counsel on what their provisions, what provisions are required, and certainly you can see that there's been massive increases. The one outlier that's not terribly clear from this chart is Deutsche Bank has not increased its loan provisions as greatly as other lenders, and I think that's largely on the basis that its outlooks are slightly different, and I think it's following more faithfully the guidance from the regulator in trying to take a sort of a pragmatic view to borrowers who are unable to make repayments at the moment. But generally speaking, banks are making large provisions for bad debts. I think they are, notwithstanding their guidance, expecting bad debts to come in at some stage. And I think at the end of the next payment deferral period, I think we could certainly see some tightening of the market. And certainly, I think the anecdotally, the advice is that the retail mortgage market is beginning to tighten slightly as well. So I think certainly the autumn of this year we can expect pretty important to see how all of this is playing out. And that's pretty much what I wanted to say, I think.
Thank you very much, Simon. And I'd like now to hand over to Janine to talk about LIBOR transition and the FCA guidance in relation to that.
Hi, everybody. I'm just trying to share my screen to get my slides up, which hopefully should work. And we'll go back to the top. So the first topic that I'm going to talk about today is LIBOR transition. That this has been obviously an ongoing issue for a while. The FCA decided in 2017 that LIBOR should cease to be the key benchmark relied upon by the markets, and since then it's been working with market participants to manage an orderly transition.
Janine, you just need to go to slide view. If you just clicked from beginning at the top, on the top left, from beginning.
Okay, does that work now?
Perfect, thank you.
Sorry about that. The latest development has been a legislative solution is now proposed to deal with what are known as tough legacy contracts. So the FCA has been working with market participants to make sure that there's an orderly transition and that contracts are amended where necessary. But there's now recently been an acceptance that there are some contracts where it's not realistic to renegotiate or amend them, and so a solution was required. The solution that has been proposed is that the government has made an announcement that the Financial Services Bill will deal with this by way of amending the benchmarks regulation from 2016 as amended to allow the FCA to have powers to require the administrators of benchmarks to change their methodology in circumstances where it's necessary, essentially. And one of the key circumstances, obviously, the FCA has in mind is the cessation of LIBOR in the end of 2021. So the new powers will take effect when the FCA makes an announcement that LIBOR is no longer representative and will not be restored to representativeness. That's a bit of a mouthful, but the terminology comes from the benchmarks regulation. And the idea is in general to make this within the FCA's control. So the FCA can decide when it will have the power to change the methodology for LIBOR. The FCA can then tell the administrator of the benchmark to amend its methodology according to what the FCA requires in order to produce a LIBOR that works to protect the integrity of the market and consumers. So that's what we know. This is what's happened. There are a lot of things, however, that we don't know. And there are more things that we don't know than we do know about these new powers and how it's all going to work. So one of the things that's the key things that's not clear is which contracts are going to be included in the definition of tough legacy, and in fact whether or not the FCA will actually identify which specific contracts it considers cannot realistically be renegotiated and amended. It's just not clear whether there's going to be a particular category, and if so, what it is. It still seems to be the possibility that the new legislative LIBOR, which is what we'll end up with, if the FCA tells the administrator how to set LIBOR not according to the bank submissions, which is the current methodology, we just don't know what that's going to be and whether it's going to apply to all contracts that haven't been amended or whether it's just going to apply to certain contracts that fall within the definition of tough legacy, if and when we're told what that is. The other uncertainty is which currencies and tenors the new LIBOR will cover. The FCA has acknowledged that it may not be realistic to publish it for all tenors and currencies, but it's not clear which ones will and won't. I mean, it's likely to be the the less commonly used ones that won't continue to be published, but it's not clear exactly which those will be. And the other big uncertainty is what will the new methodology be for setting LIBOR? So how will the legislative LIBOR be arrived at? It's likely to be based on the risk-free rates, such as SONIA, for example, for the sterling markets, that the FCA is trying to ask market participants to use, but it's not clear on what basis and whether it will be, for example, the swap market has decided to use SONIA compounded in arrears is the methodology, but will that be the same for the new legislative LIBOR, which is at the moment is a forward-looking rate? It's a big uncertainty there, and the FCA is consulting with market participants and will be over the next few months, but it's likely to be some time before we know exactly how that's going to work, which obviously creates a lot of uncertainty for parties who are deciding what to do about their contracts. Another issue is how the FCA will ensure it doesn't interfere with contracts that have already been amended. So there's obviously been pressure since 2017 to deal with legacy contracts, and some of them have been amended, and some new contracts will have been entered into with fallback provisions, and it's not clear the extent to which those will then be triggered or not triggered insofar as LIBOR does continue to be published. So that's the wording of contracts that have already been amended will need to be looked at carefully, and that's an issue that needs to be scoped out, is, you know, to what extent will this interfere with the triggering of the fallback provisions? Will it be triggered in a situation where LIBOR does actually continue to be published in some form? And the other issues are whether the new legislative LIBOR, as we're calling it, will play out if you've got mismatches in portfolios where some contracts have been amended and are considered contracts that can be amended, and others are not. So if you've got, for example, an interest rate hedging product alongside a loan, if that's been dealt with in accordance with the ISDA protocol for amending and creating fallback for LIBOR secession, but the loan agreement is then considered to be a tough legacy contract, will the two match? Will there be a problem? And how will that be dealt with? And then the next issue is the value issue. So if payments will change, so one day you're going to be paying LIBOR, if it switches over onto the new legislative LIBOR based on whatever methodology that is, will there be a spread? If so, how will it be calculated? And it seems inevitable there will be winners and losers, but it's not going to be clear for a long time, and possibly not even until the day itself, who's going to be the winner and who's going to be the loser. So that doesn't really seem to have been thought through and dealt with yet. And in terms of litigation risks, it's a space where there clearly are going to be disputes, but the new powers that have been given to the FCA and the uncertainties around that probably create a bit less certainty about where the litigation risks are. So there are going to be issues, I think, with contracts that have been amended where parties feel like they haven't been properly informed in a situation where actually LIBOR now is continuing, and so we won't know until it happens. But if the new LIBOR that's published turns out to be more advantageous to one counterparty than the amendment that's been dealt with, you know, is there a conduct risk involved in that, and has the issue been properly explained to the party, to the customer? For example, if it's a loan agreement with a bank, they will have to be very careful to make sure that customers are properly informed about all the options, and that's very difficult in the current situation where there's so much uncertainty around exactly how the new legislative LIBOR will work. So lots and lots of issues in relation to LIBOR that are ongoing, and hopefully we'll get some clarity in the next few months. But what is clear is that the FCA has decided to carry on with the secession of LIBOR, notwithstanding the COVID crisis. They've amended some of the interim deadlines, but the overall message is it's still going to happen, albeit there is now this power to solve the tough legacy on terms that have not yet properly been established. But there we are. So that's my update on LIBOR and the key things that have happened over the last few weeks on that. I've also providing an update on some aspects of the FCA's response to COVID-19. So we've heard from Nigel and Simon some of the aspects that they focused on in relation to, for example, personnel, and also in relation to the capital requirements. I'm going to focus on a document which came out with the FCA's concern in relation to the likelihood of increased capital raising. So the FCA is foreseeing that as a result of the COVID crisis, lots of capital raising is going to happen over the next few months, and also that a lot of it's going to happen in circumstances where people are working from home, and picking up on what Nigel said about that. So the FCA has reminded firms of some key principles that they need to think about in relation to capital raising, and that they still, despite the difficult circumstances we're all working in at the moment, they still have to look after the following things. So basically, ensuring inside information is properly identified is still important and is not misused, and ensuring it's properly disclosed so that investors are not misled. Firms are still expected to maintain robust market surveillance and suspicious transaction and order reporting. And in particular, in relation to that, the FCA is reminding people that, yes, okay, we understand that it's more difficult when everyone's using alternative working arrangements, but it's still expected that firms will make sure that it's happening. Also meeting transparency and short position covering requirements. Again, just a reminder that is still important and still needs to be dealt with despite the unusual circumstances we're all in. And managing conflicts of interest remains important as well. So it's just an interesting aspect. This is the FCA is looking out there and thinking about what's going to happen, what sort of activity is going to increase, and is reminding firms that their key principles and the key things that need to be focused on haven't changed just because we're in this crisis and everyone's working differently. So that's there are obviously lots and lots of aspects to the COVID-19 response, but that the focus on capital raising I thought was interesting. And then another topic that's come up recently is on the 11th of June, the FCA, following a consultation, has published its guidance on how it will assess whether firms have adequate financial resources. And again, there's not that much new here, but it's more a case of improving clarity and making it clear that these things, the way the FCA will look at things has not changed, and they will carry on. In relation to adequate financial resources, the FCA is keen to focus on the minimising harm. So just sort of picking up on the similar theme to Nigel was talking about with senior managers, this idea of looking at where and when significant harm can be caused to the markets or consumers, and then working backwards from there to make sure that the firms have got the right practice in place to make sure that that doesn't happen. So there's no intention, the FCA has emphasised, there's no intention generally to require firms to have increased financial resources in order to ensure adequacy, but it's a question of looking at what's proportionate to make sure that significant harm can't occur. And it's not, this initiative was not driven by COVID-19, but the FCA has highlighted that COVID-19 is not a reason to back off from looking at adequate financial resources. It's actually a good reminder of why having adequate financial resources is very important, because it's this sort of crisis that can lead to problems if you don't have adequate financial resources. So the general principles are to ensure that firms have robust systems and controls, governance, leadership and culture that reduces the risk of harm to consumers and markets. So there's nothing particularly new there. It's all terminology that we've heard before, but it's just re-emphasising the way that the FCA is going to look at it, and the focus on the risk of harm. And ensuring that there's a proportionate and consistent approach to the assessment of adequate financial resources. So that's looking at what is the risk and how big is the risk, and therefore making sure that you take proportionate steps according to the level of risk to make sure that you've got adequate financial resources in the event that something goes wrong, essentially. And again, making sure firms have adequate resources that reflect the harm they might cause to consumers or the markets. This is the sort of guiding principle throughout all of this guidance, is looking at the risk of harm and then taking proportionate steps according to the level of risk to make sure that consumers and the markets are not disadvantaged in the event that there's a problem or a failure within the firm. So reducing the likelihood of failure would impact consumers in the UK financial system, and minimising harm in the event of firms' failure is the exit the market by having having adequate resources and effective wind down arrangements. So again, it's all just looking at the potential for harm to be caused in the event that there's a financial problem with the firm, and making sure that there's adequate resources to ensure that if the firm does want to exit the market, that it does so in a way that doesn't damage consumers, and also minimises the pressure on the financial services compensation scheme as well. So the firms are now to carry out their own assessments at least annually of what the risks are and whether they have adequate financial resources. And so the guidance is that the assessment should consider a forward-looking approach to risks and how they evolve through an economic cycle. It all seems like common sense, but it's just a reminder of these are the things that firms have got to show that they've done and dealt with in the way that the FCA expects. Reflecting the risks to which the firm is exposed and the amount of risk it poses. So the bigger your risk, the more you have to focus on making sure that you've got more resources. Proportionality is a key theme as well in relation to the likelihood of the risks occurring. So if there are big risks but there's a small chance of them occurring, that's a different situation to having big risks and a high chance of them occurring. So you've got to look at what are your risks, how great is it, the risk that you will, if something goes wrong, you'll cause harm to consumers in the markets, and if so, how likely is it that that risk will come to fruition? These are the principles the FCA is going to expect firms to have looked at and covered. Ensuring you're financially sound while avoiding excessive costs, which could hinder firms from carrying out the business in a viable way. So there is an acknowledgement that it's not commercially viable for firms to operate if they've got to create a position where they just can't viably have adequate resources to cover all the potential risks, even if those risks are small or unlikely. Well, they may be big risks that if they come to bear will have a huge impact, but are not very likely to happen. And it's balancing that and working out a risk assessment that balances the need to have adequate financial resources with the FCA does acknowledge that it's not necessary to incur costs that are completely excessive and make your business not viable overall. And yes, and as the headline says, that these assessments need to be carried out at least annually, and that you should also keep reflecting on the fact that your business environment is changing. So overall, the message from the guidance is the overall objective is to minimise the potential for harm and avoid the risk of a disorderly exit from the market that will cause harm to consumers and also cost the industry a lot of money in terms of the levy for the Financial Services Compensation Scheme. So that's my update, and that's all I have to say at the moment. But if anyone's got any questions, obviously we're very happy to deal with them, and I'll hand back to Robin.
Thank you, Janine. I've had a few questions put to us, which you can see yourselves in the Q&A section. The first one from Jeff Hudson-Searle came has been answered by Nigel. The question.
I'm happy to paraphrase my answer if you like.
Yes, please do, Nigel.
So Jeff asked about the recent Wirecard scandal and why the FCA have not addressed executive directors and the SMCR as part of SMCR compliance. I don't know the ins and outs of this, but Wirecard is a German company and in the UK just had a subsidiary. And I know there have been investigations going on around Wirecard, but I think those are around the German parent. And I think probably the reason why we haven't seen anything yet, and it is yet, because there could be, the FCA only works so fast, is because I think the decision makers and the people who are probably responsible for the effectively the payment fraud going on at Wirecard were almost certainly in Germany, rather than sort of within a sort of a regional office in Newcastle.
Thank you, Nigel. So there's a couple of other questions that have been asked. The first one is from Hannah Doherty, who asks, how have firms responded to the FCA's announcement on the 30th of June regarding the new deadline for certifying staff and, subject to consultation, training staff on the conduct rules? And I think that's one for you, Nigel, as well.
It is, unfortunately. So this is the FCA's announcement. I should have mentioned it in my slides actually, but this is the FCA's announcement on 30th of January, 30th of June rather, that that they're basically delaying the requirement to certify staff for solo regulated firms from I think it was just the 9th of December 2021 to the 31st of March. Sorry, 9th of December 2020 this year to the 31st of March 2021, clearly with a view that people may or may not be back in their offices in sort of September, October, at a time when you would expect that training to be done, and therefore giving people more time in which to certify, decide which staff to certify, and to train everybody else on the conduct rules. How are firms responding? I expect with some relief, because it's, I mean, I went through the training process when the Bribery Act regime was brought in, and it was and firms take these things very seriously, and we did a whole series of in-house lectures to make sure that staff in the firm knew about the Bribery Act. And I think the same thing here about conduct rules. It requires quite a level of training, and I expect if you're a regulated firm, you're going to be hoping that, glad that this can has been kicked a little bit further down the road.
Thank you, Nigel. Now, the third question we have is from Derek Dale. Hello, Derek. And his question is, to what extent does the panel consider that the guidance from the FCA across the board and the COVID situation in general means that there may be more scope for the courts in the context of waiver and estoppel of the exercise of contractual rights to make sure this is done in good faith? Well, I'm happy to kick that off and say this is in the context of guidance from the FCA and the PRA that they expect financial firms and banks to exercise restraint in enforcing their strict legal rights under their contracts, and to provide some forbearance and waivers in good faith to ensure that not too many of their borrowers go into default. Now, the issue I think that Derek is referring to is the limited scope of good faith under English law. And I suspect it's going to be interesting to see how this pans out, and whether it works in a different way to the fallout from the financial crisis a decade ago, when banks came in for a lot of criticism in the way that they acted towards their customers. Obviously, banks will be in the same, under a huge amount of pressure as they were then. So there's going to be a similar pressure on them, but I think the FCA are hoping that the reputational damage which occurred to banks and other financial institutions after the financial crisis will be something they will wish to avoid, and that they will try to forbear on exercising their contractual rights as much as they could do. I mean, on the specific question of waiver and estoppel, I mean, although good faith is has limited application under English law, there are some defences, limited defences that borrowers can use when it comes to waiver and estoppel. Clearly, the contractual documents need to be considered carefully as to what rights the banks actually have to waive their rights, and whether they're bound by those waivers and acts of forbearance. The parties need to ensure that any standstill agreements or forbearance agreements are documented, and that everyone is clear as to what is being agreed. And also, I mean, there are other general English law provisions such as doctrines such as promissory estoppel, which may well apply if the bank has made a promise to forbear, and as a result of that, the customer or the counterparty has suffered financial loss. That may come into play. I'm sure there will be a wave of litigation in relation to them, but before that litigation arrives, I think there will be a lot of scope for lawyers to be involved in the contractual negotiations between lenders and borrowers in relation to breach of financial covenants. And we're already seeing quite a bit of creativity between lenders and borrowers, neither of whom want to see too many defaults. to ensure that financial covenants are either not breached or that waivers are put in place. And I think that will continue for some time. Obviously, if the recovery does not occur pretty soon, the limits of how far financial covenants can be waived will be tested pretty severely. We may see that towards the end of this year. I hope that's some kind of answer. I don't know if anyone else on the panel wants to add anything to that.
I agree with all of that. I thought it's a really interesting question. The only thing I'd add to it is that I think obviously you'd expect most banks to get their documentation right in terms of a waiver. So certainly the first round of waivers, you would generally expect the contractual provisions to be pretty tight, and you would be unlikely to then see this be a more general waiver than just the one instance. But I think as you see more waivers continuing over the course of the year, we've come to the end of one deferral period, but we're going to be approaching the end of the second. As that goes on, I think then the estoppel arguments come into play a bit more, and I think there will be some interesting litigation on the back of that.
Yes, I mean, just to add that it's both the FCA and the government have been keen to emphasise that, this idea that everyone should essentially play nicely and behave reasonably and fairly. But none of it is necessarily going to be binding. So that's my query about talking about the FCA and its role. There are obvious limitations to the extent to which even the FCA's rules can generally be enforced, particularly by companies directly, as opposed to individuals. And above a certain size, you're outside the scope of the Financial Ombudsman Service. And so I think there are probably, as Simon says, these issues are going to run for a while. It's not going to be clear what the fallout is going to be for another, at least another few months. And at some point, things are going to start coming to a head. And as Simon's identified, this unusual situation has created a lot of discussions and unusual circumstances that can then, lead to arguments about whether estoppel comes into play at the end of the day. But I don't think, at the moment, there's the move in relation to good faith doesn't seem to have a huge amount of impetus. And while the government has issued non-binding guidance, essentially suggesting that people should behave in good faith, it's not being legislated for, and it's not binding. So it remains to be seen whether the courts will pick it up in the same way as the government has and move in that direction. But thanks for the question, Derek. I know good faith is a topic that you know a lot about. So hopefully you'll probably have some comments on it yourself.
Yeah, I think I would just add that there are a lot of companies and banks who are, and I would agree with Janine, it is limited application that the FCA are able to use. They've got limited leverage, and I think they're just trying every tool that they have in the toolkit in order to try to reduce and smooth the obvious friction that's going to be between lenders and borrowers. But I think it is quite limited scope, particularly in the area of commercial lending, which the FCA admits is not something which is regulated technically by them, although they've said that they would like to do so or have an influence on that by means of the SMCR, by requesting that senior managers are actually put in a position where they must consider the interests of customers. But so it's a limited. They've got limited powers. I don't see any likelihood that the fundamentals of English law are going to be changed, certainly not by the government. But it will be interesting to see how the courts address this issue. Okay. If there are no other questions, I'd be very happy to bring this to an end. But obviously, if you do have further questions or you think of further questions later, please do feel free to contact any one of us at Collier Bristow. Thanks very much for joining.